Hello, my name is David Stuart. I'm Tasplan's Chief Investment Officer, and I'd like to welcome you to the second video update we're giving on the coronavirus situation on financial markets. Now, our last video update was actually back in February, and at that point we did caution that we had very little idea how significant the virus would become and how quickly and fast it might spread around the world. Unfortunately, since then, most of the news has been bad. Clearly, the virus has become a global pandemic, and it's infected almost every major developed market in the world, particularly the US, the UK, Italy, and Spain. Here in Australia, we've done pretty well so far, and the good news is that our rate of infection has come down significantly as the government's put in place these social distancing measures, which have tried to break down the transmission of the virus between people. However, although that virus situation may look good here, the impact on financial markets has been very, very substantial, and that includes the Australian stock market. Most stock markets fell about 35% from the beginning of the virus outbreak until late March, although they have subsequently had something of a bounce. So most markets are now down between 20 and 25% in the year to date. Australia hasn't been spared because although we don't have the same level of infection as other countries, we have implemented measures which have a significant impact on our economy. So we too are going through a dramatic economic downturn in order to try and limit the virus spread. Our own market is still off 25% from its highs, and the strong element in our market of both financial stocks and commodity stocks really hasn't helped, because those are both sectors which tend to be very exposed to economic recessions. Now, most assets which are driven by growth and which contain risk have actually fallen over the last couple of months, and that includes the Australian dollar. Now, that's the one slither of relatively bright news for Australian investors, because the fall in the Australian dollar has offset some of the falls in overseas share markets for those who have left their investments unhedged. And most of Tasplan's overseas equity investments are actually left unhedged. So typically about half the fall has been removed by the fall in the Australian dollar. Now, for Tasplan members, the high level of diversification that we've got in our multi-asset options has proved to be beneficial in limiting the amount of downside that members have experienced. So for our balanced fund, over the financial year to date, since the beginning of July last year, we're currently down about 4% or so, which is significant, but less than that which you might expect given the equity market falls. And the benefits of our life cycle approach have also come through. For those of us in the default life cycle maintain strategy, that's the older members of the Tasplan life cycle strategy, in fact the falls in the financial year to date have been less than 1%. So there are some benefits to reducing risk as you approach retirement. So that's where we are today, but I'm sure what you all really want to know is what's going to happen next. And so that's the topic I'm now going to turn to. But I'm afraid once again, I'm going to have to say that everything is still incredibly uncertain. Although we may be able to map out exactly how far the virus may go and when it may likely peak in various economies around the world, what is far more difficult to ascertain is how quickly economies can bounce back from the very severe impact that the social distancing measures have had. As I mentioned before, the recession we're going to have in the next quarter or so is likely to be as deep as that seen during the Great Depression. So it is very, very significant relative to the sorts of recessions most of us have seen in our own lifetimes. And the question is, how quickly will economies bounce back? Now, clearly, when social distancing measures and lockdowns are removed, we will see an immediate bounce in economic activity. But it will be a bounce rather than a return to where we were, I suspect. Remember that We have had an enormous impact on business and consumer confidence resulting from this virus, and it seems very unlikely that business investment and consumer spending will quickly return to where they were before. So I think it will be a slow and gradual recovery rather than a very swift bounce back. Now, governments will also need to constrain their fiscal spending at some point as we move beyond the virus period. Their deficits have really ballooned because of the size of the spending measures being put in order to support economies. So I think fiscal spending will have to come down at some point, government spending. However, I think that means that we will see a continuation of very, very low, close to zero interest rates, and the continued use by central banks of quantitative easing techniques for a considerable time to come. So that is likely to be years rather than just months. And that does provide at least a reasonable backdrop for financial assets. Now, for investors, I think the real question is whether equity prices at these levels have now discounted the recession that we are just entering, and whether in fact they are now at reasonable levels for longer term investors to return to the market. Now, our view is that current share prices do reflect a significant recessionary impact of the virus measures. However, the question is whether they fully reflect the likely slow recovery in the future. The other aspect is there is uncertainty as to whether the virus may return at some point. So although we may conquer the virus in the next few months, there is still the risk that it could come back towards the end of the year, or it could mutate into another more virulent virus. So I don't think we're necessarily out of the woods just when the virus numbers start to come down. Now, in general, given that somewhat cloudy outlook for share valuations, we would recommend that Tasplan members remain in a long-term investment strategy. It is incredibly difficult in these very volatile markets to try and time going into and out of equity markets. So we would suggest that you stick to a long-term plan. If you're unsure whether your current choice within the Tasplan options is appropriate, we would suggest that you speak to a financial advisor in order to determine whether or not you're in the right option for your financial circumstances. Now finally, before I go, I just wanted to provide a couple of comments on some issues which have been in the press recently and which have also received some queries in our call centre. Now the first of these is unlisted asset valuations. And you'll be aware that Tasplan does have unlisted property and infrastructure assets within its portfolio. Now, Tasplan has taken measures to implement new valuations as swiftly as we can when we get appropriate valuations from our fund managers. So we have already had revaluations, for example, of Hobart Airport and our infrastructure portfolios, and for our property portfolios. Our aim is to make sure that our valuations are correct for all members at all times, and so we will update valuations in these very, very turbulent circumstances as swiftly as possible. Obviously, the impact on some assets is much greater than others. You'll recognise, for example, that Hobart Airport has been severely impacted and has had a significant down valuation, whereas our unlisted prime property assets typically have had a much more modest impact on their valuation. Now, the second issue I wanted to quickly mention was there's been talk in the press about the liquidity problems that some super funds may face due to continued member switching into cash and the advent of the government's early super withdrawal scheme for people who have been put into financial hardship in the current economic circumstances. Now, I would stress that Tasplan has a very large amount of cash within its current asset mix, and that we think that we're well placed to meet both member switches and also member withdrawals if needed. We've done quite a lot of planning as to what the likely impact of these measures will be, and we're quite comfortable that we can meet this easily from our cash reserves, but also aware that most of our other assets are also very liquid. We only have about 20% of the portfolio in illiquid unlisted assets, and so we're well placed to make sure that we can continue to provide whatever our members need in the future whilst maintaining a good strong asset allocation for those members who want to maintain their current investment strategies. And with that, I'll wish you farewell, and I do hope that my next video update I may have some brighter news to give you than I have done at this one. Thank you very much.